because our lecture is like 3 hours long, okay? So I can understand that towards the end, okay, and especially in the second half of the lecture, you guys may feel like, I cannot catch up, okay? I cannot keep track of what we're talking about. So therefore, it's very useful for me to go over briefly, okay, maybe 20 minutes time, okay? We'll go over the stuff we talked about in last week's lecture so that your memory can be connected somewhat, okay? You know where we were and where we are going, okay? So what did we talk last week? Okay, we basically finished this part of the slides. We specifically talked about the 9 stellar effects in the asset market. We're using S&P 500 during the 10-year period from January 1st, 2001 until December 31st, 2010 to illustrate those stellar effects. And most important stellar effect here is the first one, okay? We introduced a very important concept for this first stellar effect that is called the partial autocorrelation. It's called the autocorrelation. It's called the autocorrelation. Okay, we oftentimes use ACF, okay, to denote autocorrelation. ACF meaning autocorrelation function. Okay, whenever you talk about autocorrelation, you always associate it with a certain lag or order. Okay, they mean the same thing. For example, autocorrelation of lag 1 is referred to the correlation between return at time t and the return at time t minus 1. Okay, it tells you how the observations along the timeline, how they are related with each other. Okay, the lag 1 here indicating the time difference between those observations. Okay, because this is time t information, this is time t minus 1 information. So therefore, if you are thinking about how today's information is related to yesterday's information, because the distance in one period or one day, so we call that autocorrelation of lag 1. And similarly, autocorrelation at lag 2, that is the correlation between RT and RT minus 2. Or equivalently, you can also say this is a correlation between RT and RT plus 2. Okay, so as long as the distance, the time distance between the observations in 2 periods, you can call that correlation autocorrelation at lag 2. Okay, so basically you can define, or you can estimate the autocorrelation for as many lags as you want, as long as your data allows you to do the estimation. Okay, for example, if you have the data, for example, the time series we take a look at from here, we know this is 10 years of data, and every year we have about 250 daily observations. So in total, we have about 2,500 observations in this sample. Okay, so then you can actually estimate autocorrelation up to lag 2499. Okay, 2499, because you can ask, oh, what is the correlation between day 1 and basically between the first observation and the last observation. Okay, so basically you can estimate the up to how many lags as you want. Okay, as long as your data allows you to do it. But oftentimes, okay, we don't estimate the autocorrelation for that long. Okay, for example, in this slide or in this example, we estimate the autocorrelation up to lag 100. Okay, up to lag 100. And this is one of the most important data sets regarding asset market. So it is fully illustrated in this figure. Okay, so basically this figure tells us in the asset market, okay, the autocorrelation between returns, they are close to 0. Okay, they are very close to 0. If you take a look at the y-axis, okay, you can see the magnitude almost never go beyond 10%. Okay, you know, they are all kind of between negative 10% and 10%. You know, this magnitude of a correlation is basically not distinguishable from 0. Or in other words, you can basically say they are all close to 0. And how to interpret this figure? This figure basically tells us, okay, if you know yesterday's return, you know very little about today's return because they are not related. Okay, in other words, if you know today's return, you know very little about tomorrow's return because it's very difficult to predict tomorrow's return using today's return. Okay, so that is the nature of the asset markets. Basically, the markets are pretty much efficient. Okay, all the information that can potentially predict the market is already impounded into the stock price. So therefore, very difficult to forecast based on past information. You have a question?
Yeah, just to make sure. So you said like an asset market, the present and the past results are like the autocorrelation is zero. That's what you said, or what did you say? What is the autocorrelation zero, or what?
Oh, so basically this is the sentence. So the daily asset return, they have autocorrelation very close to zero.
Okay.
Okay, and the next statement I was talking about is how do we interpret this? Okay, so we know an equation here that is autocorrelation close to zero. So what do you make of this statement, or what does this tell you?
So what do you mean daily return?
Oh, because the returns we are looking at here are daily, right?
But daily return of what? Individual stocks or like overall?
Oh, okay. So this, okay. So the figure from next slide here, this is estimated based on S&P 500. But when we're talking about the status effect here, when we're talking about daily returns, it refers to return on any assets. So basically, if you are looking at stock assets, okay, on the index, on individual stocks, on bond market assets, or some like crypto assets, okay. So all the assets, they will have this kind of pattern. If you are not sure, you can, if you actually have a portfolio, right? You can actually take a look at the daily return dynamics and take a look at the autocorrelation. I think you guys at this point, you are able to do it. Okay, you are able to, as long as you can get the returns, then you can plug the returns into the R code. Okay, I showed you guys last week. You can use the ACF to make the autocorrelation function plot, and then you can have a look at how the autocorrelation is behaving for that particular asset that you are interested in. Okay, so so this is one of the most important. So I want you guys to. I spent a lot of time talking about this concept as well as showing you guys how to reproduce this figure. Okay, so because why do I spend so much time? Because it's so important. Because in the many of the future lectures, we are going to talk about the concept of autocorrelation. Because you can see that the title of this course is Financial Time Series and the Volatility Model, right? So autocorrelation is basically one of the most important concepts related to financial time series. Especially in finance, we are very interested in forecasting. Okay, we care very much about how past information can tell us about the future. Okay, so therefore we really pay attention to how to use the autocorrelation on a day-to-day basis. Okay, and then the rest of the status effect we went over those pretty fast. Okay, we know that the stock market, they don't behave, especially the daily return. Okay, they don't behave like a normal distribution. Once in a while, okay, there will be returns that is beyond the 2 standard deviations, okay, or 3 standard deviations. Okay, we call those tail events, especially the events showing up on the left end of the distribution. Those are very concerning to investors. So therefore, if there are days when the S&P give us a return of negative 7%, negative 10%, okay, those are the events not really captured by the normal distribution. So therefore, in the second half of this course, we are going to be learning tools that are able to capture or identify those non-normalities and then further address those non-normalities in our risk measures. Okay, and then we also know the stock market exhibit occasional very large drops, but not equally large up moves. Okay, in other words, the distribution is not symmetric. Okay, so observations on this side, they are slightly more frequent than observations on this side. Okay, but interestingly, if you pay closer attention to what's going on in the market, okay, you will find out the observations in this area and observations in this area, they are oftentimes happening very close to each other. Okay, basically on one day when the market tanks, on another day, maybe the next day or maybe 3 days later, the market will bump up. Okay, the reason why that happened very close to the how investors trade. Okay, sometimes in response to very negative news. Okay, especially if you have leverage. Okay, you worry, oh, my portfolio will be wiped out. Let me quickly sell something. Okay, and that's gonna push down the return of assets. And then the next day, okay, you hear about some positive news. You realize, oh, probably the market isn't that scary. Okay, we should go back into the market. Okay, so they're gonna push up the return. So basically, both the large positive return and large negative return, they oftentimes happen, during the same period. That's why we strongly recommend investors to hold. Okay, instead of very actively trading, you should hold because you never know what's gonna happen tomorrow. Oftentimes today there's gonna be a large drop, and then tomorrow gonna be a very quick kind of bump up. Okay, so all those are features of the stock market. And then we also know from the daily return data that the mean return, they are negligible, very close to zero, okay? Not even 1 basis point. Whereas the standard deviation of the returns, they have in about 140 basis points. Okay, so basically, when you are looking at or when you are studying daily returns, your attention should be fully devoted to studying the volatility dynamics. Okay, instead of focusing on forecasting the expected return, but that's gonna simplify our job big time. Okay, so basically, in the future lectures, we are basically learning volatility models instead of expected return models because expected returns are going to be taken to be zero. Okay, and then stat effect number 5. Even though returns themselves have very little autocorrelation, but if you take the returns to square, that's gonna give you a measure for variance. Okay, and this time series actually exhibits mildly positive autocorrelation. You can see that up leg 10, the autocorrelation is positive and around 40%. Okay, that tells you what? That tells you, okay, if today is a high variance day or high risk day, okay, then tomorrow is more likely to be a high risk day as well. Okay, so the risk will not go away immediately. Although return could be, today dropped by 10%, tomorrow it's gonna be up by 10%, then the 2 days cancel out. Basically the correlation is very, very little, right? But the variance or the risk don't behave like this. Okay, if today the risk is high, really high, then oftentimes tomorrow or maybe today, the day after tomorrow are also high risk days. Okay, the risk will not go away from the investor's mind that quickly, but return could be kind of like this. Okay, so this is the pattern of risk. And then we also know that return or the equity return and the variance, basically there is going to be a negative correlation between variance and the returns. So how to understand this pattern? So basically oftentimes, okay, when there is a very large negative return, in the near term, the risk will go up. Okay, the risk will go up. So that is a very natural kind of response, right? And oftentimes it's exactly because investors expect in the near term the risk will be up. Therefore, they sell in advance. That's going to drive down the returns. Okay, so this is a fact, labeled by or termed by the economist called leverage effect. Okay, leverage. So it basically related to the firm's corporate leverage, and we are going to be talking about this in the second half of this course. Okay, and then we also know the correlation are time varying. We also know, even after standardized returns, you still have factor the normal tails. And then we also know the non-normality of the return distribution is related to the frequency of the returns you're looking at. Okay, the higher the frequency, the more or the larger the deviation from the normal distribution. So if you are going to be a portfolio manager for people under retirement, okay, so let's say you become like a pension fund manager, and then oftentimes they don't care about the day-to-day fluctuations in returns. They care more about what are the return dynamics in the next 3 years, 5 years, 10 years, 20 years. Okay, when you are looking at returns at this frequency, then you don't have to pay that much attention with, tail events, because the return will look more like a normal distribution. Okay, will look more like a normal distribution. So that is the first part, and then we quickly learn a generic model of asset returns. Okay, all the stuff we learned in lecture 1 will show up many times in future lectures. For example, this generic model of asset return. Okay, so and this is the daily return for tomorrow. Okay, we're using t+1 to mean, because right now we are standing at time t, right? t+1 basically meaning tomorrow. For tomorrow's return, it's going to come from two components. The first one is what we call expected return, and the second figure t+1 is what we call volatility. Okay, and the t+1 is what we call a shock. Okay, we oftentimes use a standard normal distribution to denote the shock process. Okay, and because mean are very close to 0, so we can basically get rid of this. Okay, so all our attention is to model the volatility. And if you have a volatility model, then you can use the random number generator available on all software packages. Okay, you can simulate a bunch of shocks or standard normal shocks. Then you take the product. That's gonna give you potential paths for future returns. Okay, that's gonna give you potential paths for future returns. Then, then you're gonna ask me, okay, can you give me a model for volatility? We learned one last time. Okay, it's the risk matrix model. So basically, the risk matrix model looks like this: it's 94 sigma t squared plus 6% of RT squared. Okay, and the risk matrix model is the first model that we learned in this course to forecast volatility. Okay, to forecast volatility. It's the first model, meaning that that's not the only one we're going to learn. Okay, so in lecture 5, we're going to learn another large class model also can help us forecast volatility. But what I want to highlight is that forecasting volatility is an important thing we do in this class, okay? Because we care about volatility a lot, and we really want to forecast where it is going. It's going to be high or it's going to be low, okay? And interestingly, even though returns are very difficult to forecast, as we learned from the previous slides, but volatility or variance, they are much easier to forecast, okay? And the very defining feature of any model for forecasting is that you can only use the information that you know up to the point when you are making the forecast. So you cannot say, okay, let me forecast the return of tomorrow by the end of tomorrow. That's not forecasting, right? You already know what the return is, then it doesn't make sense to make the forecast. You can only forecast tomorrow's volatility when the market is not open yet. Okay, and based on the information you know up to the point when you're making the forecast. For example, take a look at the right-hand side of this equation. We have two pieces of information, or two inputs in this risk matrix model. Okay, so one input is basically the volatility for today. So that is something we can already get. Okay, and this is the return of the market for today. That's already something you know after 4 p.m. Okay, after 4 p.m., before you leave the job, you can already forecast the volatility for tomorrow. Okay, so and you can see the two coefficients here are basically 94% and 6%. They sum up to be 1. Okay, and this is a model proposed and estimated by the research team at JP Morgan Chase. Okay, and it turns out that the parameters here, they are very stable across a wide range of assets. So basically, no matter which asset you are looking at in the future, whether you are looking at S&P 500 or you are looking at individual stocks, or you are looking at the bond market assets, you can always use those parameters. Okay, so last week I showed you guys how to use this risk matrix model specifically. Okay, also in a coding, our coding context. Okay, and the very interesting thing about using the risk matrix model is that you should have a starting value, which we call sigma 1. Okay, you should specify a starting value to start the iteration, right? To start the iteration, and whatever value you put here doesn't matter much for the forecast that you have today. Okay, because the impact of this value will go away or will die out in a couple of periods. Okay, so therefore, whichever value you take here, you don't have to be so anxious. Oh, should I pick a high value or low value? Should I pick a 0? As long as this is not a crazy number. Okay, this one is volatility at day 1, right? It shouldn't be a negative number, right? So as long as it is a positive number, then you are fine. Okay, so the impact for your forecast for tomorrow, is driven mostly by the return dynamics. It's not driven by the initial value here. So, and then we illustrate how to use the risk matrix model last week, okay, to study the S&P 500 daily return dynamics during that 10-year period. And we learned that this model, although it looks like super simple, but it's very useful, okay? It was able to capture the 2 high-risk episodes we know, during that 10-year period. So, in the earlier half of the 10-year sample, we have the dot bubble period, right? In the latter half of that 10-year period, we have the global financial crisis, okay? So basically, if you use the risk matrix model to capture the volatility dynamics, they were able to capture the 2 spikes in volatility during those episodes, okay? And of course, if you extend the time series, okay, from 2010 to 2026, okay, you will be able to capture some of the high-risk episodes. Well, the most notable ones in the past 15 years should probably be the COVID, okay, basically March of 2020, okay, but it's very different. The COVID pandemic period of the market, very different from the dot bubble period. It's very different from the global financial crisis in the sense that the period is too short, too brief. Basically, the market panicked in late February and then almost recovered in April. Okay, so basically, the recovery just so quick. So if you are looking at like a quarterly return data, you won't be able to find that there was a panic there. Okay, so that is something very interesting about the market in the past 15 years. And then, okay, so this is that. Then we also talked about something important, that is what we call the value at risk. Okay, value at risk. This is the primary risk measure we are going to be working with, okay, in this course. So, and for any risk measure, we want it to be defined as a positive number. So why is that a desired feature? Because if the risk measure is always positive, then a larger number will tell you that's going to be a high risk situation, okay, or high risk scenario. Okay, unlike returns, right? Returns could be very negative, could be very positive, and actually more negative numbers are a higher risk situation, right? So that is not desirable. So when we create or when we estimate the risk measure, we want this measure to be always positive, so that a larger number or a high magnitude number always corresponds to a higher risk situation or scenario. Okay, so therefore we know the relation between VAR and another important concept we talked about last week is basically the negative of the quantile. Okay, the negative of the quantile. And whenever you talk about VAR, you always associate it with a certain coverage rate. Okay, coverage rate. For example, we're talking about 1% VAR, 5% VAR, or 10% VAR. Okay, so that 1%, 5%, or 10%, those are the coverage rates of the VAR measure. Okay, and if we kind of extrapolate this relation, so basically the 1% VAR is exactly equal to the negative of 1% quantile. Okay, so basically, let's say you have a histogram. Let's say you have a histogram of the daily returns, okay? And then how do you estimate the VAR? Or where do you find the VAR from this histogram? Based on this relation, all you need to do is to find the 1% quantile. And we know quantile is a purely statistical concept. Okay, it basically tells you the cutoff on this distribution such that lower numbers is happening with a certain probability. So the 1% quantile is basically somewhere here. Okay, it's a cutoff value right here, such that the more negative observations they are happening, or smaller observations they are happening with exactly a 1% chance. If that is the location of this cutoff, and then this is location called the 1% quantile. And you guys realize that if this is the histogram of the daily return, because return have a mean of around 0, so 0 should be around here, right? Then this number almost surely will be a negative number, because we want a VAR to be a positive number. So therefore, that's why we put a negative sign in front of that 1% quantile, and we do get the 1% VAR. So that is how we get the VAR, okay? From any distribution, okay? Not only return distribution. Sometimes when we talk about VAR, we also talk in terms of portfolio gains or losses. Basically, this side is going to be portfolio gains, and this side is going to be portfolio losses. Okay, the units are going to be mailing or bailing. Okay, depending on the unit you are looking at. When you are looking at the returns, the unit, there is no unit. Okay, with return. But when you're talking portfolio gains or losses, then there will be unit. But you can always plot this histogram and find out the corresponding quantile from this histogram, and then just put a negative sign there. You are able to get the corresponding VAR measure. Okay, and exactly because of this relation, you guys quickly learn that it is, okay, in any context, okay, if I give you a related VAR statement, okay, if I tell you that I'm a portfolio manager and I'm managing a pension fund for my clients, okay, and the 1% VAR of my portfolio, of course, because I don't want to disclose my specific portfolio composition, right? Because that is kind of private information. But what I can tell my clients is that the 1% VAR of this portfolio at the height of the global financial crisis. So, for example, in November of 2008, okay, and the 1% VAR is 10%. How to understand this statement? Okay, how to understand this statement? So basically, to understand this statement, you need to convert it. You need to convert this VAR to quantile, meaning that the 1% quantile of my portfolio is negative 10%. Okay, it's negative 10%. Meaning that from this histogram, if this is the histogram of my portfolio daily returns, and then this cutoff is going to be negative 10%. Okay, meaning that for that particular day, there is a 10% chance. Oh, if that is 1% quantile, right? So there is a 1% chance my portfolio will do worse than negative 10%. Basically, there is a 1% chance my portfolio will give a return that is in a neighborhood of negative 11% or negative 12% or negative 15%. So that is actually very scary, right? And managing portfolio for people under retirement if your portfolio can do so badly, during this day, and then that's gonna cause concern. You have a question?
So when I think of value at risk, and I'm a very literal thinker, so I need to step outside of my comfort zone a little bit here. If I have a portfolio of $1,000, when I think of value at risk, I'm thinking what percent of that, what's the value of that 1,000? So when we're talking about 1% value at risk, 5% value at risk, 10% value at risk, that's not in relation to the 1,000. Each one of those 1, 5, 10, it's in relation to another variable as well.
Oh, okay. So as I just said, when you're talking about the VAR, okay, you can talk about the VAR in terms of returns. You can also talk about VAR in terms of portfolio changes, portfolio value changes. Let's say you have a portfolio of $1,000, right? And then today, the change in the portfolio value is $100, a positive $100. Okay, it gained by 10%, basically $100. And tomorrow it dropped by 5%. Basically, the loss is $50. Okay, so you can again make a histogram of that, and you can talk about, okay, what is the 1% VAR, what is the 5% VAR. So at this point, or in this case, you are going to be talking about the portfolio value changes. You can still talk about in the VAR in that context. Okay, so that is the kind of. Oh, you have a question?
Does this mean you said the portfolio will be worse than 10%?
Your portfolio return smaller than negative 10%. Okay, so that is basically what we talked about last Tuesday. Okay, last Tuesday. So today we're gonna continue talking about VAR. We specifically will talk about two approaches, okay, to estimate VAR. Okay, two approaches to estimate VAR. Okay, so, and what are the two approaches? Again, if you are trying to estimate VAR, you really need to keep in mind about this diagram or this histogram, okay? Because everything is going to be related to this. Okay? And also you really need to know what is VAR and what is the concept. And we're going to be talking about two approaches today. And then, in the future, we're going to expand or further develop those approaches. Okay, so we're not going to stop here. So today, we basically, have very little tools, okay? We only learned about the risk management model, and that model turned out can be helpful in terms of estimating VAR. Okay, so how do we categorize the approaches to estimating VAR? So we have the first of all, let's talk about the parametric approach. Okay? The defining feature under this parametric approach is that you are going to make the assumption that tomorrow's return is going to follow a normal distribution. Okay? So basically, under this parametric approach, you are going to assume the RT plus 1 follows a normal distribution. Or in other words, the histogram of your tomorrow's return of RT plus 1 is going to look like, this is going to be the histogram of the RT plus 1. You can see this is actually beautifully, it's a very beautiful bell-shaped curve. Or in other words, it's just like a normal distribution. And because we know RT plus 1 has a mean of 0, so we basically put the mean of 0 here, okay? And then to estimate the quantiles from this diagram or from this histogram, all you need to know is the volatility of RT plus 1, okay? And how do we get the volatility? The risk metric model can help us get that. Okay, once you learn the mean and the volatility of a normal distribution. And then this normal distribution is basically pinned down. Okay, it basically determined, it's fixed. And then you can figure out any quantiles that you are interested in. For example, if you are interested in estimating the 1% quantile, okay, and then R can help you find out the 1% quantile from this normal distribution. And there is a command called the Q norm. Okay, there is a command called Q norm. Q basically meaning quantile. Q norm meaning the quantile of a normal distribution. Okay, this command will quickly help you figure out, okay, what is the cutoff from this, what is the cutoff of this normal distribution? So if you give Q norm the mean information, the volatility information, and then the Q norm can help you find out the quantile right away, okay? And then all you need to do is to put a negative sign in front of this cutoff, then you will get the var. Okay, you will get the var. And that's gonna be the parametric version of the var. Okay, it's just like as simple as that. Okay, as simple as that. And you can see that the defining feature underlying this approach is the definition or is the assumption of a normal distribution. Because we are going to assume the returns of tomorrow follow exactly a normal distribution. And then the job becomes, okay, if I know tomorrow's return follow a normal distribution, and I know the meaning of that normal distribution, if I can figure out the volatility based on the risk matrix model, then I know the whole shape of this normal distribution, then I can know the 1% quantile, 5% quantile, whatever quantile you are interested in. And then the var is going to be very naturally a negative of that quantile, right? Then you have your version of the var measure. Any questions before I show you guys the code? Okay, if no questions, let's quickly take a look at the code. The code is under the lecture 2 folder. Let me open the R. Okay. As always, let me change the font size to be larger. Okay, so therefore you guys can take a look at it. Then I need to make sure that the working directory is the lecture 2 folder on the desktop. Okay, so I find the lecture 2 folder on the desktop. I select that folder as the working directory, and therefore I can open any files in that folder. The VAR is what I'm going to be working with. You can see the portions of the code we already went over them last week. Okay, so I think we are here. Okay, so this is what we are going to be talking about today. Okay, but before I run this portion of the code, because I'm going to be using the sigma square we estimated for the risk matrix model. Oh, actually, I don't have to. All I need to is to load the S&P 500 data, then I can run this portion. Okay, so basically, what I'm going to be doing is this. Okay, so this portion of the code, something we went over one line by one line last week. Okay, so basically every line of the code, you know what it is doing here. Okay, and then let's quickly run it. Control R. Okay, you can see. So whenever you run R code, okay, so if there are no error messages showing up here, meaning your code is running smoothly. Okay, that is good news. Okay, and sometimes there will be warning messages here. Okay, warning is still fine. It's meaning something is not okay there, but you are still able to run the code. Okay, but the difference between warning and error is pretty much like it's like a driving ticket. Okay, it's like a ticket versus like a warning. Okay, like if it's warning, meaning the code was still able to run out smoothly. But if it's error, meaning the code basically stopped, okay, stuck somewhere, it cannot run. So therefore you got and if you see this kind of screen, and so basically empty clean screen, meaning that's even better. Okay, meaning you are able to get everything you want from the code. And then the next part is we are going to exactly follow this parametric approach. And you can see to estimate the parametric var, at first it creates two variables. One variable is called sigma square, and the other variable is called var1. So that's var1 basically meaning 1% var. Okay, I'm going to be estimating 1% var. And then numeric, okay, t, basically I'm going to create, you know, a numeric vector or vector that has only zero in the vector. Okay, and why do I do that? Okay, why do I do that? Because this is purely for creating a variable beforehand, before you do the for loop. Okay, this can help you save some of the computer memories. Of course, right now you don't feel the pain of running out of memory, but when you are dealing with larger and larger data and larger portfolio and longer data, your computer memory, you know, may sometimes run out. So therefore, you have to really carefully control the kind of memory that is, you know, the computer code are occupied. So therefore, sometimes we want to save memory space. We create that beforehand. Okay. If you don't do that, okay, if you go directly into running the for loop, the code can still run, but the downside is that because you can see the variable here, the length keeps increasing because R doesn't know how long the time series will be if you don't pre-specify it. So therefore, the variable will keep increasing in length. So therefore, the memory will be reallocated every time. It's gonna create a lot of kind of duplicate data in your R workspace. So therefore, if you can pre-specify it and then you reassign the value, that's going to be much cleaner, okay, in terms of computation. And we can see we are going to be estimating the two quantities there. One is the volatility square, the other is the 1% bar. So we pre-specify them, okay? And then we are going to start the for loop, okay? We basically have like 2,500 daily observations within that 10 years, okay? So from day 2, okay, we can come up with the use the risk matrix model to figure out the sigma square for day 2. You can see here, we didn't even specify the initial value for the risk matrix model. If you don't specify, meaning that initial value is 0, that is fine. That is fine because we know the value, the initial value impact will go away fairly quickly. Okay, so therefore you can see 94% sigma square at day 1. Basically, when I is equal to 2, this is sigma square at day 1. Okay, times 94%. This is going to be the return at day 1 square times 6%. You add them up. That's going to be the sigma square at day 2. Okay, and then the next step is estimate the bar. Okay, you can see I'm first using Q norm to find out the 1% quantile of that normal distribution. And the 0.01 here is basically the probability that you are associated with the quantile you are looking at. Okay, if you are looking at the 1% quantile, you want to put 1% here. And then you have to tell R what is the mean, what is the standard deviation of the normal distribution you are trying to estimate the quantile from. Okay, so the mean is 0. We know for daily return that's going to be 0. And what is the standard deviation? That's going to be the square root of the sigma square you estimated right before this line. Okay, basically the square root of the sigma square right here. Okay, and this Q norm is basically the quantile of the normal distribution. And then don't forget the negative sign here. Okay, and then you can get the 1% bar. Okay, and then you can the for loop basically can help you do this, you know, for forever long time period. Okay, if this time period is 100 years, you can still use the for loop to do it. Okay, so basically the T here is about 2,500. So basically we are running the for loop from day 2 until the end of the sample. It's from January 2nd of 2001 until December 31st of 2010. And then we can make a plot of the 1% bar and take a look at the dynamics. Okay? Any question with the codes?
I've got a question.
Oh, you have a question?
Well, what's the point of a warning message if the code runs correctly? Not an error message, a warning message.
So sometimes, you know, the warning messages is closely related to, for example, Let me give you an example. So some of the commands, okay, in R, they have some specific requirements. And if the information you give that command do not satisfy the underlying requirement, then it will show up as warning messages. It doesn't affect the running of that command, but the command will the developer of the command still want you to know something might be correct, might be incorrect. So you better pay attention to, but it doesn't affect the running of the code. We will have cases like that in the future. Whenever that happens, I will tell you. Okay, so don't worry, we're gonna see a lot of codes. You will not always see clean code like this. Okay, so in practice, okay, it's all in the real world. You're more likely to run into error messages and warning messages. Okay, only when the code is already well written, you see something like this. Okay, so you have.
This is the same question for numeric T, concept function, same thing. Why this different name? This will be an error if we run it.
You mean numeric T?
Yeah. Numeric T. Basically, this is the name you name for the function, right? And numeric T is the same, but this have different name, sigma.
Oh,
square.
numeric T is basically a vector of 0. You basically assign it to sigma square. You assign it to 1% bar. It doesn't create conflict here. Okay. Okay, let me show you what is numeric T. So let's say you see numeric, okay, 5. That's gonna give you basically 5 zeros. You are basically assigning this. You are basically assigning this all 0 vector to that variable. That's gonna be the initial kind of version of that variable. And then you can see, when we are starting the for loop, right? We're going to assign the estimated sigma square to this value, and then to this value, to this value. That's gonna be our estimated sigma square series. Does that make sense? I'm not really answering the question. I don't understand your question actually. You can ask me afterward during the break. So let's run this. Okay, let's run this. You can see that it doesn't take much time. Okay, because right now the code is still the data is still relatively small. So now let's take a look at the 1% var. So this is basically the 1% of var. 1% of var estimated from the S&P 500 based on the parametric method. Okay, and then you can see that the dynamics looks very similar to the volatility dynamics. Okay, so basically we are able to see 2 spikes. Okay, one is between 2001 2002, and the other spike is basically in 2007 2008. Okay, because VAR is a risk measure. Okay, so therefore you do expect to see higher values of the VAR when the market, when the economy is going through a financial crisis. Okay, especially when the market is kind of panicking. Okay, and basically if I point out any number on this graph, you should be able to interpret what I mean. For example, okay, let's say this is what we call the height of the financial crisis. Basically, the height is the value for the VAR. Okay, you can see roughly this is happening in the fall of 2008. I'm not sure whether that's October or November, but roughly there. And take a look at the y-axis. Okay, how high is that VAR measure? That's somewhere around 12%. Okay, basically meaning that during those days, okay, the S&P 500 with 1% chance, the S&P 500 will deliver you a return that is even more negative than negative 12%. Okay, that is very scary, right? If you have all your wealth in the stock market, then it can lose 12% of its value. If you are taking on leverage, it will lose more. Okay, so this is basically what a risk measure can tell us. So, okay, any question with this approach and how to do it? and then how to interpret it, okay? So so that's it. And we are going to compare this version of the var with another version. Okay, so although we close the window here, but I want you still keep a short-term memory of what it looks like. Okay, because we are going to compare another version with that version. Okay, in a few minutes. Okay, so what is the second approach? The second approach is called the non-parametric approach. Okay, non-parametric basic accordingly, okay, because in the parametric approach, you have to make the assumption of the normal distribution. And then in the non-parametric approach, you are basically not making that distribution. It is totally fine because we know, or we already know that daily returns don't follow exactly a normal distribution. So therefore, if you wanted to go with this non-parametric approach, it totally makes sense. If you truly believe daily return cannot be modeled by a normal distribution, then you are going to choose this non-parametric approach. So how do we go with this, or how do we, estimate var based on this non-parametric approach? So basically, you will have to make a histogram of the daily returns. Okay, you will have to make a histogram of the daily return. Obviously, when you are making the histogram, you don't assume it follows a normal distribution, because if it follows exactly a normal distribution, the histogram should look like this. Okay, when you are making a plot as ugly as this one, it means it could be any distribution. Okay, could be any distribution, and then by the definition of the var, okay, and you can see that by the non-parametric approach, all we need to do is to find some data, okay, and then make this histogram, and then find out the corresponding quantiles, okay, from this histogram, and then we put a negative sign in front of that quantile, and then we will get the var under this non-parametric approach. Then the next question you're going to ask is, where do you get the data? Okay, where do you get the data? So let's say for the S&P 500 example we were playing with, okay, we have data from January 1st of 2001 until December 31st, 2010. So to make this histogram, you at least need some observations, right? So let's say we use the 1 year window to estimate the quantile. So basically, we use the first 250 daily observations, we can make this histogram, okay? And then based on this histogram, we can estimate the quantile. And then we can put a negative sign in front of that quantile, and then we can have the var, okay? So you can see the defining feature of the non-parametric approach is you first have to start from some historical data. Okay, you have to choose very carefully the window of the data you wanted to use to make this histogram. Okay, and that's why the non-parametric approach is also called, it has a different name called historical simulation. Basically, the historical base here basically meaning that we are going to be using the historical data to make the histogram. Okay, let me further highlight, let me further explain or further illustrate how to exactly use that. Okay, so let me erase all of this. Okay, let's take a look at in very specific data context how we do it. So let's say the data we have here is R1, R2, R3, okay, and then you can see R249, R250, R251, R252. Okay, this is the time series we are looking at. Okay? And you can see I'm highlighting those observations, very clearly. So to estimate, so basically, let's see, where do we stand? We stand at the end of day 250. So why do we stand there? Because we need at least 250 days of observations to make that plot of the histogram. So therefore, we have to wait until we have enough observations. So that gives us, day 250. Okay, at the end of day 250, we stand there. The vertical line here, okay, oftentimes meaning where you are, okay, in terms of time. Okay, if I'm drawing a line between day 250 and day 251, this line meaning you are standing at the end of day 250. Okay, and then you use this window of data, basically from R1 until R250. Use that window of data to make the histogram, to find out the quantile, to find out to put a negative sign, to find out the var. That's gonna be the var associated with day 251. Okay, basically you are using the past 1 year of historical data to inform you about, or to make inference about the return distribution of day 251. Okay? And then what is next? After you have the var for day 251, what is next? You're going to move 1 day ahead. So basically you are going to be using the return window of day 2 until day 251, and then you remake the histogram, okay? And then go through everything. Basically remake the histogram and then find out the quantile, put a negative sign, okay? That's gonna give you the var for day 252. Okay, for day 252. Then you basically repeat this process until the end of the sample. Until the end of the sample. You will get another version of the var, and this is the non-parametric approach. Okay, or in other words, the historical simulation version of the var. So the very nice thing about this approach is that you do not have to make the normal distribution assumption. Or in other words, this approach has the potential or has the capacity to capture the non-normal behavior in the market or the tail events in the market. And whereas in the previous parametric approach, because you assume a normal distribution to begin with, and then from the very beginning you completely eliminate the presence of tail risk. So therefore, that approach cannot capture the presence of the tail risk, even though when there was tail risk in the market, that approach will not be able to capture it. Okay. Whereas this parametric approach, whereas this historical simulation or non-parametric approach has the potential to capture it. Meaning, you have to pay close attention that I'm using the potential here, meaning, there is scope to do it. Okay, even though from the graph I'll show you guys, you may not be able to see it, but don't forget about this approach. Okay, we are going to further develop this historical simulation approach in the second half of this course. Okay, so let's first take. Oh, you have a question?
Is it the standard to use 250 days of data in order to use the historical simulation? Can it be less or more?
You mean it is standard to use what?
The 250 days of data that you mentioned.
Oh, basically how long the window,
Yeah,
right?
how long
Oh, it's a very good question, which I'm going to be talking about, after the exercise. But given that you're asking about it, right? So I can talk briefly. So basically, for the historical simulation approach, and you guys quickly realize that important modeling choice here is basically how long the window length is, right? How long the window length is. So that window cannot be too long, cannot be too short. Okay, it's very kind of tricky here. Okay, why? Because if the window is too short, let's say you only have 50 observations of the historical data, and then when you are making the histogram, you can imagine this histogram will not be densely populated. Okay, the observation will be very sparse on this histogram, meaning that when you are estimating the quantile here, that quantity will not be estimate it accurately, okay? And at the same time, that window cannot be too long, okay? 50 is not a good idea. And you may ask, oh, why not we choose a 4-year window to estimate the quantile? That is not a good idea either, okay? Why? Because, we are using the historical information to inform us about what may happen tomorrow, right? If you have a 4-year window, meaning, okay, you are standing at the beginning of 2005, you are looking at the information from 2001 and 2000 until 2004, basically 4 years of data. You can imagine that the more recent information should be more relevant for making the forecast, right? And what happened in 2001 shouldn't matter much for what's going to happen in 2005. So therefore, that window length shouldn't be too long either. So therefore, we are choosing a middle ground, okay? And where that middle ground is, okay, is more of a personal choice, okay? I personally, okay, in this course, for illustration purposes, I'm using 250 because that's exactly 1 year of data, okay? Because we are doing 10 years of data, and 250 is exactly like a round number corresponding to 1 year. If you prefer 300 days, it's totally fine. If you prefer like 400 days, it's totally fine. If you prefer 200 days, it is fine as well. Okay? So basically, where that middle ground is more of a personal choice. But I wanted to highlight that window shouldn't be too short. Otherwise, this diagram will be too sparse. Okay? It cannot be too long because it's going to contain too much of the stale information that won't carry any value for us to make the forecast. Because the VAR still is, when we're estimating VAR, we are still forecasting what is the risk situation for tomorrow, right? For any forecasting exercise, the more recent information always carry larger value. So the stale information shouldn't matter that much. Okay? So that is something we clarify before we. Oh, you have.
Do you have a recommend for how long of the window we should use, like 5 years or 10 years? Or
how long the window?
Yeah.
So my recommendation is basically 1 year.
1 year.
Basically 250 days. Okay, that's actually exactly the window length I'm going to show you guys in the code here. Okay, let's take a look at it. So that you can see that I'm going to estimating two versions of the VAR. Okay, you can see again I'm pre-specifying everything. Okay, so here we have the 1% VAR underscore 250, meaning that 1% VAR is estimated with a historical window length of 250 days. Okay, and this variable is pre-specified to be, a vector that contains all zeros. And then VAR 5 underscore 250, this is basically 5% VAR. Okay, again estimated with a historical window of 250 days. And then you can see I'm going to start the for loop. Okay, I'm going to start the for loop. But because, okay, as this example just shows you, you don't have 250 observations up, and basically in the first 250 days, you don't have enough observation. You have to wait until, exactly you have this amount of observation. So basically, we are only able to estimate the historical simulation version of the VAR starting from day 251. Okay, because that's the first day we have exactly historical observation. That's why you can see the I here starting from day 251. Okay, and when I is equal to day 251, and the return here, we put it here, is basically, you can see when I is equal to 251, this is basically 1, right? Until 250. Basically, the return window we are looking at is exactly the return from day 1 to day 250. Basically, we're going to be using this window to inform us of the return distribution for day 251. Okay? And the very nice thing in R is that once you have this histogram, or once you have this data sample, there is a very handy command called quantile in R, okay? And this command exactly helps us estimate the quantile. So basically, all you need to tell R, or tell this command is, what is the data? Okay, this is basically the data. And what is the probability you want to associate it with the quantile? That's basically the coverage rate of the var. Okay, if you are trying to estimate 1% var, just put 1% there. If you are trying to estimate 5% var, put 5% there. You can see that's exactly what I'm doing here. And always don't forget about the negative sign. Don't forget about the negative sign. And then you can run this very quickly. Okay, run this very quickly. And then we're going to make the plot. Okay, we're going to make the plot. Okay, so we're going to run the plot. Okay, so now you can see again, you don't see error message, don't see warning message, meaning everything ran smoothly, right? Then the next one we're going to do is we're going to make the plot in red color. Okay, in red color. So this is basically how the historical simulation version of the var looks like. Okay, how it looks like. You can see why I wanted you to keep a short memory of the previous version of the var. I just wanted you to make comparison with this version of the var. Okay, the biggest difference between the two versions is that this version of the var looks like very static, too smooth, right? Looks like, you know, it's kind of like, it doesn't move up and down, it looks very smooth, and then gradually drops down a low level, and then, you know, stay there for 4 years, and then it go up, okay? And the most dramatic thing is that in the global financial crisis, we know a lot of things that happen in the market, okay? Today we're hearing some company is going, like, bankrupted, and then another company is kind of liquidated, and so on and so forth. A lot of things happen in the market. But once you estimate the var, for a long time, you can see the var doesn't change. It stays flat. Stays flat. So the defining feature of the historical simulation of the var is basically that it's very smooth. It's very smooth. In other words, it's not dynamic. Not dynamic. So the next question is going to be why this is the case. How to make sense of the so smooth var measures. Okay? Oh, you have a question?
Yes. Say for example, with this illustration that you made on the board, from R1 to R250. Yes, because this is what I've seen with historical simulation questions.
Yeah.
In between, you see a blank space. My question is, can you able to depict the relationship all the way to the 250th term? And in most cases, the VAR, they will say, is the last, you know, the last 3 or the last 4 worst case scenario. You understand?
Yeah.
Yeah, so that is what I'm trying to gather from this. Is it possible that from R1, R2, R3, let's say you are doing up to 250 or 500, you know,
you use the window of data.
The window of data, exactly. So you find out that you have a relationship that you can able to depict at initial, like R1, R2, R3, and you have a gap, and then you go to R249, R250. So I'm a bit lost in that particular direction. How to be able to get the relationship together?
What do you mean by the relationship?
Say for example, R1, R2, R3, it's like a series.
Yes, it's a time series.
Yes, it's like a series. Okay. So now my question is, in between, there are no relationship. You understand?
Oh, there are still. So those are kind of omitted, but you have
omitted.
R4, you know,
Exactly.
Everything. Yeah.
Yes. So that is why I'm saying, I said in some, I've seen some historical simulation question, that is the way they do it. And at the end of the day, the question will ask you, calculate the 99% VAR, which will mean they will say is the worst 4, you know, losses. So which means it will fall within the last around 249, 250, and all those ones. Yeah. So my question is, how are you able to connect the dots?
Okay, I think I somewhat get your question. Your question is basically, we are only concerned about the very kind of severe situation,
Exactly,
right?
exactly.
Why do we need so many data there? Right?
Exactly.
Okay. Okay, so the reason is because the good versus bad, it comes from comparison, right? If you don't know, if you for example, let's take a look at this histogram, right? So those are the observations you are concerned about as a risk manager.
Yeah.
Okay, but the historical data here, right?
Yeah.
You don't know which observations are going to be in this region. It could be R101, could be R97, could be anything, right? So therefore you have to use the whole data sample to make this histogram, and then allow allow the data to tell you which observations are most scary. Or maybe on day 97 it's a scary day. Maybe on day 98 it's gonna be a scary day. We don't want to make speculation about that. Just let the data tell us
Okay.
what is the tail, what is the shape of the distribution, which days we are concerned about.
Okay.
And then we are going to capture that by the quantile.
Okay.
Okay. So I think the next important thing I wanted to explain from this pattern is basically why the graph is so smooth, or why the plot is so smooth, why it's not as dynamic as the var time series from the parametric method. Okay, so that's actually something very important. So why that is the case? All we have to go back is the approach itself. Okay, so take a look at how we do it. Okay, from one day to the next day, what are the information we are using to draw this histogram? Okay, for day 251, we are using this window, and for day 252, we are using this window. So the meaning is that, or the inference is that, from one day to the next, the majority of the information or the observations we are using to make the histogram still the same, right? We're basically getting rid of one observation and then we are adding another observation. So basically maybe 99% of the information, they're still the same. That is why from one day to another, this histogram itself will not change a whole lot, okay? And that's why the quantile will not change a whole lot, and that is why the var will not change a whole lot. That's why from one day to another, it could look like this. It can look like a flat line, right? Looks like a flat line. Looks like a flat line. And that is the big picture underlying why the historical simulation version of the var is so smooth. It's because the information we are using to make the inference, they are not changing that frequently. So when it will have patterns like from here to go up, okay? When that's gonna happen, it's when the new information you are adding here is a very bad day. Okay, it's gonna drag the histogram toward that direction. Then you will have, larger numbers of the var showing up gradually. Okay, so I hope everyone understands what I'm talking about. So basically, when you are comparing the parametric versus the non-parametric, the time series have different shapes. Okay, one is very dynamic, the other is very flat. But regardless of flat versus dynamic, the good news about the two approaches is that they are both able to capture the relatively speaking high risk episodes. Take a look at this historical simulation version of the var, right? Even though it's very smooth, but you still have a spike here. You still have another spike here. Okay? So basically, large picture wise, the approach is still useful, it's still good. But in terms of details, they are slightly different. And you guys need to understand how the differences arise, where the differences are coming from. Okay? And
Since we're using this big data, so isn't it important to know exactly the timeline at which the
historical simulation are? You mean is it important to know on which day it
Which
goes?
day, like, it goes, like, user.
Well, if you are a risk manager, of course you care about at which day the risk manager go up, right? If let's say you you are doing this work on a daily basis, right?
Yeah.
every day you report to your manager, oh, what is the VAR measure? Oh, every day go back with a small number, 1%, 2%. Oh, we're good, we're all good. Right? We're having a risk going forward. And then all of a sudden you have a VAR measure like 10%. And then you know right away this is a very high risk episode. Of course, you will quickly get something bad is already happening in the market.
Because in this history, it only shows the rate and the volume of the stock that we picked, right, like the 2,500 with the X axis.
Oh, you bet. What does that mean, right?
Yeah.
The x-axis, basically we have about 2,500 observations. So basically this meaning December 31st, 2010, and this meaning December 31st, 2008. Okay, this means December 31st, 2006, 2004, and 2002.
But you would have to know what happened that day in order for you to know.
Oh yeah, of course, when you are looking at the code specifically, you can correspond with the day to the, we're not showing this, very kind of coarse way. You could have, if you put more lines there, you could have the date right here. Okay, and we are just not, because we are looking at exact 10 years of data, so we are not putting all of those information there. Okay, so let me summarize. Okay, let me summarize the two approaches to estimate VAR. They have their merits, respective merits. Okay, basically each approach has its own pros and cons. Okay, for example, we know that if you, are concerned with this time series is too smooth, okay, you, for example, at the height of the global financial crisis, and every day you come to your boss, manager, and you report exactly the same VAR measure as yesterday, and you're worried, your boss is thinking you're not doing the work, you're just telling him the number from yesterday. If you want a more dynamic version of the VAR, then you will choose the parametric approach, And if you want a VAR measure that can potentially capture the tail risk, then you can choose the historical simulation. So basically, the two approaches have their own strength and weakness, And then let's go back to the issue of capturing the tail risk. From this time series, it doesn't look like we are able to see tail risk. So that is what I meant by it has a potential. So basically we know this approach is able to, but from this simple version, we cannot tell right away. Maybe it's already capturing the tail risk, but we don't have a way to figure it out. So therefore, in the second half or in lecture number 6, basically the first lecture after this wind wave, we are going to improve upon this one. We are going to learn another VAR estimation approach called filtered historical simulation. It's going to combine a lot of elements there. And that approach is exactly able to help us pin down or tell us, whether the tail risk in the market and at which time. So right now, all you need to keep in mind is, we have two approaches. One is able to capture the tail risk, or has the potential to capture tail risk, whereas the other one does not have that capacity. And we know that one approach is more dynamic, and the other approach is smooth, not as dynamic. Those are the features of the different approaches. And then in practice, I ran into this question every year from students. Basically, which approach should we use? You showed me two ways. And which approach should we use? What oftentimes happens is that, because it doesn't take much time to estimate different versions of the VAR. So for a lot of times, for robustness purposes, we experiment with multiple versions of the VAR. We will report the historical simulation version of the VAR. We also report the parametric version of the VAR. In the future, we're going to learn more VAR estimation approach. We're going to add another version. Maybe we're going to present, the boss or the manager with 3 or 4 versions of the VAR. If the different versions give us the same message, that is, the risk is going up, then we're going to be very, very cautious. And if different measures give us conflicting messages, then we're going to, taking a more balanced act there. Okay, so basically, in practice, it's not about choosing which and which. It's about you guys know, okay, the different strengths and weaknesses of different approach, and you will go with all of them. And then when it comes to interpretation or taking policy action, then you should know, oh, this one has this problem, that one has that problem, then I should take this number, more cautiously, and that one with a different perspective. Okay, it's not like, oh, I have two approaches, then I should choose only one to work with. It's not like a single number. Okay, you have to present multiple kind of versions of the same thing. That is basically kind of for robustness, right? For playing with the market, we really got to be very robust. Okay. Any question with VAR estimation?
One more time, so the non-parametric approach, the historical simulation, does not assume,
Doesn't assume a normal distribution.
But isn't our S&P 500 returns by nature of it being market, not normal?
Yes, in data it is not normal, and that is why this approach has its appeals, right? Because if S&P 500 is normal to begin with, then this approach is not appealing at all. Because it can capture, and there's no non-normality to capture to begin with. Exactly because the market does have non-normality, so therefore, if you learn an approach that is able to capture it, then this approach is appealing to managers. Okay, you have a question?
Yeah, the window is just 1 year data, right?
Mm-hmm.
But if that the 1 year not reflect the prices, so suppose the volatility is very stable, not much that dynamic like this, then how can R generate like the same trend with the parametric method before? Because suppose like we forecast for the future, right?
Mm-hmm.
So we base on 2026 and then we base on 2025, and it's not the prices year.
Mm-hmm.
So if you do the same simulations for the rest of the year or next year or the next 2 years, it's
Mm-hmm.
kind of create that trend dynamic like this.
Oh, so you are thinking that the 1 year data has too much of an information that is not relevant, right?
Yeah, that's how we eliminate like one-off events of like crisis, or how we make sure that 1 year is the correct year to forecast for the next year.
Well, 1 year is the middle ground we have to stick with. You can choose more than 1 year. Just make sure it's not 5 years or 4 years. You can choose like 300 days or maybe 400 days. You can choose a window length that you are more comfortable with. As I said, it's more of a personal choice. It's just like this window shouldn't be too short, because if it's too short, when you are using the quantile,
I don't measure not too short, but like 2 year, if that 2 years nothing big happens, so if the next 2 year forecast is also similar to the last 2 years, then how we forecast for the crisis?
well, you never. Oh, actually, we are not. Whenever we do this, we are not forecasting the next 2 years. We are using the past to forecast next day. Actually, forecast next day. So we never bet on whatever happening in the past 2 years will exactly tell us what's going to happen like tomorrow, okay, or in next 2 years. We know it's very difficult, right? But what we do believe is that the shape or the distribution shape has some information. So basically, if you take a look at how the market has been behaving in the past year, the shape of the distribution is informative or has value for forecasting the shape for tomorrow. Okay, and that information is going to gradually, going to be dynamically changing and evolving. So therefore, all the new information will still be showing up in the histogram. That's going to inform us what potentially may happen. At least, okay. For example, when we are looking at S&P 500, we know that it ranges between -7% to +7%, right? So that tells us, okay, if that is the case for the past year, it's likely going to be the same thing as tomorrow. So we're going to be using that information. Basically, the shape of the distribution will not change much. It's still informative for us. It won't be something like between negative 50% to positive 50%. That's not the case. The past information tells us. We are basically having some rough idea of what, so if we're never trying to forecast exactly when the market will crash, no, that's not gonna be able. If you learn something like this, you can forecast market crashes, you won't be sitting here. Right? You are already making huge amount of money in Wall Street by buying options and futures. So it's not the same thing that we're doing, okay?
So for both model, we can forecast for the prices.
No, we're not forecasting crisis. We are estimating a risk measure for tomorrow. We're not forecasting crisis. It's just like the risk measure has some relation with the crisis. The risk measure tends to go up when a crisis happens. But we are not forecasting crisis. For example, if you see 5% VAR, would you interpret that as a crisis? Probably not, right? Because you have to compare that from a historical perspective. If for a long time the S&P 500 1% VAR is 1%, 2%, and when you see a 5% VAR, oh, then you know, or maybe, this is a high risk episode, but it may not necessarily be a crisis. Okay, in the history of S&P 500, those little spikes are happening a lot often than the larger spikes. Okay, like when there is a European debt crisis in 2013, there's going to be spike in S&P 500. Okay, when the UK, have some kind of currency crisis, there's going to be a spike. When there was an Asia financial crisis, there's going to be a spike. So all the things are going to be reflected in S&P 500. It doesn't always mean, that was a crisis in the U.S. economy. Okay, it's just like, the market and the economy has some relation, but that's not one-to-one. Okay, so therefore, the purpose of the two different approaches is is well defined. Okay, we are estimating VAR. We are not forecasting crisis. Forecasting crisis is a completely different game. Okay, completely different game.
If you were to say, I have my portfolio today, and I want to use historical S&P VAR information to help me determine, for whatever reason, how I should mitigate risk in my portfolio today. Would you say that there's anything to be gained? Because this is all in the past.
Well, if you are estimating the risk for your portfolio, you should use the historical data of your portfolio instead of S&P 500.
Right. So this is just for an example. You're not this isn't gonna tell me anything about how to mitigate risk for my portfolio today. This is
Well,
for historical.
risk mitigation, that's actually something different. Okay, risk mitigation meaning you have strategies to mitigate risk, right? Through portfolio diversification, through buying some kind of derivative to mitigate risk. So what we are doing here is to estimate risk. So whatever strategy you are taking on, okay, if you are taking on a very balanced portfolio, you have mitigated your risk. You have having a lot of bonds in your portfolio, you're gonna have low risk kind of situation. But how low that risk is, you are using the approach we are doing here. Okay, so this is estimating risk measure VAR instead of mitigating risk, instead of forecasting crisis. Okay, so that is it. And then, okay, let me quickly talk about another risk concept, and then we will call it. We will take a break. Okay. The computer is very slow. Takes like 1 minute to open PDF. Okay, so let's take a look at Okay, so basically you can see, even though I didn't open the slide yet, but a lot of the stuff I'm talking about, they are already on the slide. Okay, so then the rest of the lecture 2, I'm basically gonna briefly talk about another risk measure called expected shortfall. Okay, and this is also a popular risk measure used in practice, just like not as popular as VAR. Okay, VAR is basically very popular. And then let's quickly take a look at what is the difference between VAR and expected shortfall. Then I'm going to very simply illustrate how to do it. Okay, so you can see the first bullet point basically tells you the difference. So VAR is concerned only with the percentage of losses that exceed the VAR and not the magnitude of these losses. Or from the perspective of this histogram, what that bullet point means is basically, okay, VAR, as long as you know what is the 1% quantile, or as long as you know this cutoff level, you know VAR. You don't care about the magnitude of the return in this neighborhood. It could be very negative, could be not as negative as expected. As long as those numbers are more negative than the negative VAR, they are all in this area. Okay, but VAR doesn't capture the severity of the portfolio losses. So expected shortfall is basically trying to kind of overcome this problem. So it's also called a tail VAR. Okay, accounts for the magnitude of the large losses as well as their probability of occurring. Then the next bullet point shows you mathematically how expected shortfall is defined. So it's basically a conditional expectation concept. Okay, so conditional on what? Conditional on the portfolio returns are in this neighborhood. So basically, as long as the returns are more negative than negative VAR, and we are going to take the average of the returns in this neighborhood, conditional on any return showing up in this area, we are taking the expectation of those returns. That's going to give us the expected shortfall. And you can imagine the average or the conditional expectation of return in this region, in this neighborhood, is going to be a negative number, right? Then expected shortfall is also a risk concept. So we do not want it to be negative. We want it to be positive, again, for reasons of interpretation. Okay, so therefore, we again have a negative sign in front of this quantity to make it positive, and this is going to be what we call the expected shortfall. Okay, so all the information important for expected shortfall, they are already in this slide. Okay, so the next I will show a very kind of simple example illustrate how to calculate the expected shortfall. Okay, so let's say we have 5 observations in this area. Okay, we have about 2 observations. Let's say the 1% of VAR is, let's say the 1% of VAR for the portfolio is 5%. Okay, and then we have 2 observations. The returns are negative 6%. Then we have 3 observations. The returns are negative 8%. So let me use a very simple example to illustrate how you calculate expected shortfall. So basically, it's the conditional expectation of those observations. Okay? So we have a total of 5 observations. 2 of them are negative 6%, and 3 of them are negative 8%. So the conditional probability of this happening is basically 2 over 5. Okay? And then you times negative 6% plus 3 over 5 times negative 8%. Let's take a look at what is the math here. 12 plus 24, that is 36, right? So basically negative 36 over 5%. Basically 7.2, I believe. 7.2%. Okay? After you do the math, you figure out the conditional expectation is basically negative 7.2%. Then you put an expected shortfall is basically the negative of this conditional expectation. that's basically negative, that's basically 7.2%. So this is basically how do you calculate the expected shortfall. It's basically a conditional expectation concept. All you need to think about is the magnitude of the returns in this area or in this neighborhood. Of course, in this example, the returns are not that negative, right? We have negative 6%, negative 8%. You could also have the case of, okay, 2 observations, negative 8, and 3 observations, negative 10. Okay, actually, this could happen again in the case of when the VAR is 5%. Okay, and then if you have those observations, then the expected shortfall will be a lot larger when you are taking the conditional expectation. Conditional expectation in mathematical terms is basically weighted average, okay, of the observations in that region. Okay, so this is basically the difference between expected shortfall and VAR. And as you can see, I didn't even show you guys how to calculate expected shortfall in our code. So therefore, you know, for most of the future lectures, we are mainly going to estimate in VAR instead of expected shortfall. But I want you guys to at least know such a risk concept exists and is different from VAR. Okay, and let me do a very quick survey. So any of you guys are taking the FRM like the practice exam? So basically there was an exam, right? So
Yeah.
no.
FRM certification.
Yeah, I think it was kind of like a certificate.
It was a practice exam?
No, it's not. It's not practice exam. It's like a practitioner's exam called FRM exam.
No, I know, I heard of the exam, but I misunderstood, I thought there's like a practice, okay.
No, so sorry, I was using the wrong term. So basically, in that exam, okay, so previously, in previous years, I do have students who are studying in this program at the same time also studying for that exam. It's pretty similar to the CFA, okay, it's just like a similar exam for risk managers, okay, and in that exam, you will run into questions like this, okay. I just want to let you guys know that, you know, it's also a popular risk concept. It's just not as popular as VAR, okay. And for this course, we're mainly going to be using VAR, okay. So let's take a break, and we'll come back around 8:20, 25 to 8:30, okay.